Welcome to Legacy Private Trust's 2025 Economic and Market Outlook. My name is Connor O'Brien. I am a portfolio manager here at Legacy. Today, I am joined by two of my counterparts on the Legacy investment team, Peter Schaefer and Nick Brouch. Welcome, gentlemen. Today, we're going to talk about what we're watching in 2025 and look at a few scenarios, our bear case, our base case, and our bull case. We'll talk about the rate cut cycle. We'll talk about the policy outlook when it comes to the Trump administration, and then we'll show our current tactical positioning in portfolios as we head into the new year. So PJ, let's start with you. Walk us through what we're looking at as we head into 2025.
Yeah, I mean, I think what's really on top of everybody's mind is 2025 going to be like 2024 and 2023, where we had the S&P 500 return north of 25%. I think our base case is good, but not that good. Obviously, we hope that we're wrong and the market does run another 25%. But I think what we're looking at in 2025 within our base case, unemployment right now is 4.2%. We do expect that to remain steady. We expect demand for goods and services. We do expect that to continue to moderate, which is going to lead to some inflation reduction. But overall, we think inflation will remain sticky. What we mean by that is north of the Fed's target of 2%. What that's going to allow the Fed to do is kind of ease slowly. So for us, we're sort of hoping for steady as she goes. I think the biggest question mark for us is about deficit expansion and how that's going to impact, most notably for us. We think that could possibly lead to some comments on our bear case, which is inflation reaccelerating, the Fed really needing to keep interest rates high, which we think could crimp the stock market and also lead to some employment melt up, moving unemployment from 4.2% to quite higher in a rapid move. Again, looking at our bear base bull case, we do think unemployment will remain steady, kind of steady as she goes, but we do think there are some risks, Connor, to the bear case.
Great, thanks, PJ. Nick, over to you. Let's talk about rate cuts. Obviously, the Fed cut another 25 basis points here on Wednesday. Talk to us about how the markets have responded to rate cuts thus far and how we think they might respond to future cuts.
Sure. Thanks, Connor. So the sort of a tale of two stories here when it comes to the Federal Reserve cutting rates this year. And it was widely forecasted that they were going to cut quite a lot. And we did get quite a lot of cuts this year. Now we've sort of entered into sort of a second phase. So phase one of this was, the first 2 or 3 cuts, first 2 individual cuts of 75 basis points. The market surged about 8% up in 3 months here. Then we jumped to the meeting that we had this week, and the Fed actually had some commentary about what they expect into 2025. And for most of the year, we were expecting 4 cuts next year. That has shifted downwards rather quickly, and now the Fed is expecting only 2 cuts next year. So the market really did take a tumble on that news. You can see in the gray line here, towards the end of that line, it drops rather steeply, and that was the market reacting to some higher rates expected in the intermediate term. Now, the point of this chart is actually to show that a slower rate cutting cycle is actually good for stocks on average. So basically, we have 2 average historical lines here, and the dark blue line indicates what happens if the Federal Reserve undertakes what is called a slow interest rate cutting cycle, and that's defined as less than 5 within the first year. Now, as I said, we're already at 4, so we don't have a ton of wiggle room to go there. But if you can see, if the Fed proceeds slowly, in the long run, that's really, really great for stocks, actually. And so we would kind of view this drop that we've seen this past week as sort of being something very short term, but healthy in the long run. Compare that to the light blue line, and that's when the Fed cuts rather quickly, and that's 5 or more. And as you can see, the returns are still positive, but much less than what you would see in a fast cutting cycle or a slow cutting cycle. Now, the rationale behind this is usually that the Fed has to cut rates very quickly when we're on the brink of a recession. Our case is that we aren't in one, so we would like to see the Fed actually move slowly from this point on. but there is no guarantee here as we continue on. And as I mentioned, we don't have a ton of wiggle room here. So it's not out of the question that we're in that light blue line instead of the dark blue line, but it's something we're going to be watching very closely as we enter into the next year. What is the timing and the velocity of these future rate cuts? What can we expect in 2025?
Great. Now, sticking with you, Nick, let's talk about the election. So we're past the election. We've already had some market-moving political headlines since the election. Tell us what we can expect from a policy perspective with the Trump administration here in the new year.
Sure. I think Trump has been very, very, very adamant on what his agenda is. And it's really four key tenets here that are all kind of shown on this slide. So tariffs, deportation, deregulation, and taxes, and mostly tax cut. And the only thing that we're really certain on at this point is that everything is going to face some sort of uphill battle, rather in the court system or in Congress. Everything that you'll see here that Trump has proposed will rather face some challenges in court, or it will require congressional approval. So even though he's been elected and even though he has a majority in both the House and the Senate, that doesn't necessarily mean everything's going to get across. So it's very difficult to forecast things at this point. That being said, if we want to assume that all of these actions that have been mentioned are put into law, what we can expect is actually pretty easy to forecast. So tariff and taxes are really the easiest two in this. Both of those are going to be inflationary. Tariffs are going to be inflationary because those costs that the businesses have to pay on their raw materials that they bring into the country, they'll likely pass those on to the consumer, which will increase prices. Taxes give people a lot more money in their pocket, and that allows them to spend more, which should also boost inflation. Now, the effect of this is not known at this point because we're not really sure how much the tariffs will actually end up being, how deep the tax cuts will be, but we do know at their core they're rather inflationary. Now, the effect to GDP is a little bit different between the two because tariffs would reduce GDP, although, again, that's not necessarily a guarantee because reshoring and domestic investment could actually help to offset some of that implied decrease in GDP growth. Taxes, we know for sure will likely increase GDP growth, and that's just because people have more money in their pockets. They're willing to spend more. Deregulation and deportation are the two that maybe are a little bit trickier to forecast. Again, there's some sort of implied benefits or costs to it, but I think in the long run, we're not really too sure of what it's going to look like, mostly because the size and scope here is really to be determined. But in theory, just deportation would actually increase inflation. That's just because there's going to be less people in the workforce. Now, granted, inflation has decoupled with wage growth recently, so there's going to be plenty to be seen here as we enter into the new year. But no matter who is in the White House, what's really important to the U.S. economy are the companies that produce life-altering products and the consumers that just continue to buy them. And ultimately, what matters more than the presidential policy is how strong the U.S. economy is. And this chart here just shows that GDP growth has been incredibly strong for the U.S. relative to all other developed economies, and we're really not expecting that to go anywhere. That gray section all the way to the right shows the forecast, and really the U.S. is just expected to continue to run circles around other developed economies. So, and we've actually been benefiting in that, and I'll pass that back to you, Connor, so we can talk a little bit about positioning.
For sure, and PJ, we'll finish that off with you. So where are we tactically positioning portfolios here as we head into 2025?
Yeah, I mean, I think as our listeners have kind of listened to this video, from my base case view of sort of steady growth and continued positive momentum, from Nick's comments about what happens when the Fed cuts rates in a slow interest rate cutting environment, to policy expansion, as well to just US GDP growth, it's not going to be a huge shock when you look at this positioning. Right now, we are overweight equities, whether it's really US or international equities compared to bonds. Well, the path of least resistance for us for stocks is higher. Now, within stocks, we are very much domestic biased. We like US equities over internationals. We actually like small cap equities a little bit more than large cap. Think deregulation. Think if we get lower rates. Those are really good things for small cap stocks. Within developed and emerging markets, we are leaning slightly towards emerging markets. within government bonds and duration. I would say duration, we're sort of neutral there. Makes sense with all the uncertainty around interest rate cuts. On the government bond side, well, we're taking our risk in equities right now. So we want our bonds to be a little bit more defensive. I think that makes sense. We're sort of hedging our bets, if you will. So where does that leave the entire portfolio? We are very risk on. We were really bullish in 2024. We've had these positionings pretty much for the entire year that really worked out for our clients. Looking into next year, we are positioned to sort of continue with the pro stock market rally. Obviously, if things change, I talked about the risk to the bull and the base and the bear cases. I said, well, we might have a little bit more risk towards the bear case. If we get a little bit more concerned about equities, we will absolutely change our positioning, sell stocks, buy bonds. But for right now, we're pretty comfortable being, quote, risk on.
Great. Thanks, PJ. And thanks to the both of you for your insights here. Very informative. For those watching, thanks for tuning in. If you are a legacy client, we very much appreciate your business. If you're not a legacy client and want to learn a little bit more about what we do and how we do it, please reach out to info@lptrust.com. And on behalf of everyone here at Legacy, we'd like to wish you and your family a Merry Christmas and a safe and a happy holiday season.